Hello everyone, it's DJ and welcome to another episode of RC Retirement. Well, it is the 25th of March and this is a reshoot of an episode I did 4 days ago. I spent hours editing this episode, or the first version of this episode, over the course of several days, and I was not able to save it. The audio was garbled in many places. The video was not that good. And when I was finally done with it, the final result, I thought maybe, just maybe, I can have a video worthy of posting. Maybe. And when I hit render on the video editor, it went for about 5 seconds and then said frame number such and so cannot be read. So after, well, let's just say some profanity, I gave up. And that was hard to do because it was an hour of recording and let's say at least 3 or 4 times that in editing and post-production, which is typically the case with these videos. So I get to do this again. But that's why you didn't have an episode last week, because I was trying my darndest to save that video. I was hoping that I could make use of it before time ran out. And since it's a tax-related video, of course, it's dated material. I have to hurry. So here I am again. I'm going to try one more time. And hopefully I can get this out to you today. So let's see what happens. I'm going to try again. So, as I was saying in my first version of this video, I am subscribed to a whole litany of various newsletters and other sorts of email lists from various agencies just so I can stay on top of information and try to still keep information in my head that is current so that I can present it to you guys. So one of these things is some tax tips, which of course we all need. Tax laws change every year, so we need good information for tax purposes. And this one here, which I'm going to show on the screen, and of course for those of you in podcast land, as I love to call you guys, podcast land, you can't see it, so I'm going to give you a summarized version of what's on the screen. Alright, so this is tax tip number 2019-26. This is from the IRS. And you would think that this far into the tax year, being March 25th, and with tax deadlines being only 20 days away, that we would get this kind of information a lot sooner rather than later. Now, of course, if you're DJ, you've already done your taxes, but of course that's patting myself on the head, and not everyone is like that. Now, the good news is there's nothing groundbreaking here. There have been no major shifts in the last 3 months. The major shifts happened before the turn of the year. So hopefully what I'm about to say is nothing new to most of you. But if it is, then good. That's the point of these videos, is to get information out there and to make resources available. So here we go. So as I'm showing on the screen, we have IRS has resources to help military personnel and veterans understand taxes. And the first resource available, of course, is this tax tip newsletter, which, of course, I would recommend that you subscribe to this newsletter. The big thing to keep in mind when you are in a military status is to keep in mind, what status is that? Are you a retiree? Are you active duty? Are you a reservist? Of course, most of us here are reservists, hence the name, Reserve Component Retirement. But hopefully not all of us are retired. So you might have some of us who are retired, like yours truly. Yes, I'm one of you now, if you didn't already know. I am a retiree. But you have some of us who are in combat zones as well, and that's showing on the screen. If you are in a combat zone, then you have combat zone tax exclusion. And if you are not taking advantage of the combat zone tax exclusion, then come right here. Come right over here so I can slap you, all right? Right across the jaw, right there. Yeah, because that's a lot of money that you're losing. And it doesn't matter what rank you are. If you are not taking advantage of the combat zone tax exclusion, then you're paying a lot of money in taxes that you don't have to pay. All right. Now, the other part of the tax tip where I'm going to spend a lot of time is the Armed Forces Tax Guide. And I'm actually just going to minimize that and bring up the HTML version of the guide on a web browser and read a couple of summarized points to you. So again, you can see what's on the screen here, and we can look at a few key points. So here's some of the major points for this tax year. For 2018, this is the big one. This is the one that really shocked us all. Personal exemption suspended. For 2018, you can't claim a personal exemption for yourself, your spouse, or your dependents. This is something we've had for decades, and suddenly, poof, it's gone. So yeah, this was a major shift for us. This really surprised us all. But the standard deduction for those of us who don't itemize, not more than doubled, but essentially doubled, and in most cases made up for the personal exemption going away. Now, of course, I've probably lost a lot of people already because I'm talking numbers, I'm talking taxes, and just, Mongo head hurt, right? So don't worry, I'm not going to read all this stuff. I'm going to still try to keep it simple. All right, so increased child tax credit and additional tax credit. That's all I'm going to read on that. Just know that's there. Credit for other dependents. There's a new tax credit of up to $500 for other dependents. And it begins to phase out once you have income, the maximum income threshold at which the credit begins to phase out has been increased to $200,000. And of course, as always, Social Security numbers are required if you're trying to claim child tax credits. I don't know why people don't realize that. I'm biting my tongue there, trying to keep personal opinion out of that, but moving on. All right, limitation on deduction of state and local taxes. This is another big one. So you can not deduct more than $10,000 of your state and local taxes, including income taxes or general sales taxes, real estate taxes, and personal property taxes. All right, this one caused quite a hubbub, especially in states that had high property taxes, like California. People said, "Oh, you're penalizing us for living in these states." It's like, well, actually, your state is penalizing you for living in these states. But that's neither here nor there. I'll get into evil states in a little bit, because the other thing I'm going to do when I finish with this is talking about the best and worst states at least according to Kiplinger's.com, from a tax perspective. All right, moving on. No deduction for home equity loan interest. So sorry, guys, if you have a home equity line of credit or anything of that nature. No miscellaneous itemized deductions allowed. So if your name is DJ or you are like him and you work from home or have other sorts of work-related expenses like business use of home office, then those deductions are no longer deductible for your taxes. So sorry, DJ, or as they used to say in the 80s in the tuna commercials, sorry, Charlie. And many other expenses similar to those for a lot of people out there. Those have gone away. So things like the cost of tools that mechanics would buy for use on the job, cost of uniforms, cost of driving to and from a work site, various other things like that we used to commonly annotate and then deduct at the end of a year are no longer an option for us. So little things like that used to be commonplace are going away. All right, moving on. Qualified business income deduction. Beginning in 2018, you may now be able to deduct up to 20% of your qualified business income from your qualified trade or business. Excuse me. And I'm not going to read any more of that. You will already know if this applies to you or not. So I'm not going to spend any more time there. Next item, moving expense deduction suspended except for certain armed forces members. And I'll go ahead and read that one as well with a little bit of supposition added at the end. Beginning in 2018, the moving expense deduction is suspended except if you are a member of the armed forces on active duty and due to a military order, you move because of a permanent change of station. Now, the supposition here is that your moving expenses out of pocket are higher than the reimbursement you receive from DFAS after your move. Because obviously, if you're reimbursed for the amount of your move or more, there's nothing to deduct, right? All right. I'm not going to cover domestic production activities deduction because that does not really apply to any of us around here, I wouldn't think. Due date of return, if you live in Maine, Massachusetts, or the District of Columbia, you have until April 17th. Otherwise, you have until April 15th, just like always, to complete and mail or electronically file. I recommend that. I have to keep remembering that I have this little camera and I can't just, wildly flail my arms. I've got this little camera here. So you've got 21 days from now to get your stuff done and sent up to the internal rip-off service so that you can not be in non-compliance. All right, the last thing I'm going to touch is residence election of civilian spouse. Beginning in 2018, if you are a civilian spouse of an active duty U.S. military service member, you may elect to have the same tax residence as the service member. And that can be beneficial for tax purposes. It may not. It depends on the state. So you'll have to make that decision on your own. All right. So there are a lot of other things that you'll want to consider as well. I've scrolled down to a list of other publications that you may want to consider reading. For example, publication 501, which deals with dependents, standard deductions, and filing information. I do recommend at least scanning through that just so you know what applies to you this year. Things have changed quite a bit, so at least take a look at that and see what is accurate for your situation this year. And then some of these other particular publications might be applicable for you. Take a look at the list and select what works for you, and of course ignore what doesn't. And you can take a look at the Armed Forces Tax Guide to see what's there. I'll post a link to it in the show notes for this episode. So now let's have some fun. Enough of the drudgery. Let's have some fun here. Let's go look at Kiplinger's list of the 10 most tax-friendly and least tax-friendly states in the United States. I went through this once before, and I did have some fun with this, bashing the evil states and saying, kudos to the nice states. There were some surprises here, and there were some states that I didn't expect to show up on here. There was some that I thought would be on this list that were not. It was a bit of a shakeup. For example, my own state. I'm in the state of Georgia, and I would have thought that my own state would have fared a little bit better, but it did not appear on the list of top 10 states for tax friendliness, nor did the state of Texas, which also surprised me. So, sorry Texas, you weren't here. So, stuff to consider. So, why did this happen? So let's look at the methodology of this real quick. So Kiplinger's looked at more than just the income tax situation of the state. They considered income taxes, property taxes, sales taxes, fuel taxes, sin taxes. So whether you had cigarette and other tobacco taxes, alcohol taxes, vapor taxes for those who vape, inheritance and gift taxes, wireless taxes. So I guess that's Wi-Fi and cell phone, sorts of taxes. Travel taxes, so how much do they tax tourism? And fiscal stability. That means Illinois is probably in some serious trouble, right? All right, so they took a look at all these different factors when considering the tax friendliness of a state. So, let's just go down this list and see what's what. Now, one thing I'm not sure about here is whether number 1 means it's the best and number 10 means it's the worst, or if number 1 is supposed to be, okay, and I'm not sure if this is like a David Letterman top 10. And you should start from 10 and go to 1, or if you start from 1 and go to 10. So I'm just going to start from the top of the list and work down. Let's just go from there. All right, so we'll go from the top, and I'm thinking already that number 1 means number 1 here, because when I look at this and see Alaska as number 1, that makes me think no surprise, because when you look at no income tax, average local sales tax of 1.43%, gas tax of 15 cents per gallon, and where was it? I've read this before, so where was it? And property tax, a little bit higher than average for the country, but property taxes just slightly above the average for the country. But this still makes me think this is number one for the entire USA. And well done. Well done, Alaska. My only problem with Alaska is it's so far north, therefore cold. And DJ does not like cold, even though DJ talks about himself in the third person now and then. But that's just to be silly. All right, so moving on. Number 2, Wyoming. They have no state income tax. They have an average local sales tax of 5.39%, a 24-cent gasoline tax, and they thought to put the lowest beer tax in the land as an item of mention here. So well done for them. And they have the 9th lowest property tax in the U.S. So also well done for them. All right. Moving on. Number 3, South Dakota. No state income tax. I'm starting to see a pattern here. Average local sales tax, 6.4%. Gas tax, 30 cents per gallon. South Dakota's combined state and local sales taxes are below average for the U.S. That's good to know. Property taxes are above average for the U.S. So a little bit higher than average there. One thing to mention here, the average gasoline tax in the country is 34 cents. That's mentioned a bit later. But you can see as we go how some states fare with their gas tax. All right, moving on. Florida, number 4. No state income tax. Average sales tax of 6.8%. Gas tax of 41 cents per gallon, so a little bit higher than the national average. Property tax is about a little below the midpoint for the U.S., according to this article. And their sales taxes can get a little high in some counties. I know this just from having to charge sales taxes for some folks, where it can get as high as 8.25. But the average for the state is 6.8. So overall, not a bad state. Number 4 on the list. Moving on, number 5. Again, no state income tax. Average sales tax, 8.14. Average gas tax, 34 cents. The property tax is the 16th lowest in the U.S. Gas taxes are the same as the national average. And in addition to sales taxes, they do charge an annual government services tax on vehicles, which that's kind of sad, but they have their own little ad valorem on vehicles. But it looks like it's modest. For a $20,000 sticker price, it's $238 for a 2-year-old car. But pros and cons. All right, number 6. North Dakota. This is our first state with an income tax. And it looks like it's relatively modest. 2.9% on taxable income of more than $424,000. Average local sales tax, 6.83. 23 cents per gallon on gasoline. And let's see, there was something about their yes. Their sales tax is even lower for farming equipment. It's only 3% for farm machinery. So if you're a farmer, you save even more money there. All right, property tax is just below the average rate for the U.S. So again, North Dakota doing well tax-wise. They are number 6. Number 7, Delaware. And I said this in the first version of the video. I was surprised at Delaware because that is, at least what I would call Yankee land. I would have thought that Delaware would have been more unfavorable as far as tax situations. So let's take a look at this. State income tax, 6.6% on taxable income of more than $60,000. That's a low threshold for their highest rate. But average local sales tax, none. Gas tax, 23 cents per gallon. So Delaware's income tax rate escalates quickly, as the article here says. But they have no sales tax. They have the 4th lowest property tax in the U.S. And let's see, what does this last little thing say? Little Delaware, sandwiched between high tax states such as Maryland and New Jersey, pulls off this low tax trick by being a very friendly place for businesses to incorporate, and then collecting fees and taxes from these absentee businesses whose real operations are elsewhere. Aha! So that's their little trick. Well, good for them. All right, so number 8, Arizona. I happen to like Arizona. Number 8, they have a 4.54% income tax rate, 8.33% sales tax, 19% or 19-cent gas tax. And that's pretty low for gas, compared to 34 cents. And there was one other little thing about them that caught my eye last time. What was that? Other than just being so low. And one of my little bits of trivia, I like the fact that they don't observe daylight savings time. Like most states, the Grand Canyon State excludes prescription drugs and food from home consumption from state sales taxes. However, all 15 counties levy additional taxes, as do many municipalities, and some jurisdictions extend their taxes to groceries. Oh, wow. All right, moving on. Mississippi. And now, again, this is where I was originally surprised, because the next 2 states, while they are both in the South, I didn't expect them to fare as well as they did. So Mississippi, 5% tax on income, 7.07 local sales tax, and a 19-cent tax on gasoline. Mississippi is moving to ease its income tax bite on its lowest income residents. And by 2022, its 3% bracket, its first $1,000 of taxable income will be gone. And am I reading that right? Yeah. Starting in 2018, the first $1,000 of taxable income is exempt from the 3% rate. By 2022, that bracket will be completely gone, and the income tax will start at 4% of $5,000 of taxable income. Yeah, so they are moving to make income less taxable, not more. That's awesome. The property tax in Mississippi is the 19th lowest in the nation. Good for them. And we will move on. Louisiana, down in the bayou. They have a 6% income tax, a 9.45 sales tax, 20-cent gasoline tax. 3rd lowest property tax in the U.S., and their gas tax is significantly below the national average. That's awesome. Now I'm going to read one paragraph out of this article because it's significantly striking for this state and probably why they're number 10. Louisiana's top income tax rate of 6% kicks in at $50,000 of taxable income for a single filer. Louisiana allows residents to deduct their entire federal income tax liability minus non-refundable tax credits from their state income taxes. However, as a result of the federal tax overhaul, most taxpayers are expected to see their federal taxes decline in 2018. That means Louisiana's deduction won't be worth as much, and state taxes here will go up. So, interesting twist there. You have this great deduction for residents of your state, but because of a federal tax cut, the deduction for your citizens in the state goes down, and hence the tax rates or the tax charges for everyone in your state goes up. The law of unintended consequences strikes again. All right, so that's it for the 10 friendly states. Now let's switch over to the 10 charlatans, the 10 evil states, and see how they do. And I'm going to go through these a little faster because we've already been at this for 30 minutes, and I'm sure you don't want to spend another 30 minutes going through another 10 states. Of course, we did spend half of the 30 minutes going through other stuff, but let's continue. All right, so state number 1 for least tax-friendly states in the U.S. And no, I'm not going to try to sound like David Letterman or Casey Kasem doing a top 10. So number 1 for tax monsters is Minnesota. That kind of makes sense because they're weird up there. So they've got a 9.85% income tax and a 29% gas tax. Let's see. Strangely, their gas taxes are below the national average, but they must have some other policies that are not as cool. Maryland just seems odd. It's weird because I've got some buddies out there, but maybe they are trying to escape at some point. So Maryland, they have a 3.2. That's interesting. All right. State income tax, 2% to 5.75%. Maryland's 23 counties and Baltimore City may levy additional income taxes ranging from 1.75 to 3.2% of taxable income. The average local levy is 2.9. Wow. All right, here's why Maryland is one of the least friendly. Maryland is among a handful of states that allows localities to levy their own income taxes on top of state income taxes. That's not cool. I just came from the People's Republic of Michigan back when I was in the National Guard, and they do the same thing. The Lansing and Detroit areas, I know, do that, and I think Grand Rapids did the same. So that's not cool, guys. All right, and of course for Maryland, they also have a 6% sales tax and a 35% gas tax, making it even worse. All right, no one's surprised by this one, New York. And they do the same thing. They also have local sales taxes, local income taxes. So they have an 8.8% income tax as well as local income taxes of up to another 1.9%. 8.49 average sales tax and gas taxes of 46 cents per gallon. They have the 10th highest sales taxes in the country, and their gas taxes are considerably higher than the 34-cent average. One thing that it thought to say here, first of all, the property tax is 10th highest in the country, and as I've already said, and the state tax on cigarettes is $4.35 per pack, the second highest in the U.S., and New York City tax on an additional $1.50 per pack. So apparently you don't want to live in New York City. It's just too darn expensive. Moving on. Illinois. I knew they'd be here, and not just because I've read this once before. Now, the surprising thing here is Illinois has a flat income tax of 4.95%, which is a very tax-friendly thing to have. But let's move on. They have an average state and local sales tax rate of 8.73% and a 38% gas tax. But they also have the highest state budget deficit in the U.S., and in 2017, state lawmakers increased their flat tax rate from 3.75 to 4.95%. So things have been getting worse for people in Illinois, not better. And their sales taxes are pretty high. Their property taxes are the second highest in the country. It just keeps getting worse. And heaven help you if you want concealed carry for handguns in Illinois. It's, from what I hear, a nightmare in that little state. All right, moving on to number 5, Maine. We're going east and north. So Maine, 7.15% taxable income rate and 5.5% sales tax. Gas taxes of 30 cents per gallon. Maine has been working to lower its income tax bite. In 2016, the top rate fell from 7.95 to 7.15. However, the state's low rate is 5.8%, which is higher than some states' top rate. The property tax is 17th highest in the U.S. However, Maine is one of the few states that prohibits local jurisdictions from imposing their own sales tax, so you won't pay more than 5.5% no matter where you live or shop. So interesting little tidbit there. Moving on to number 6, Vermont. Stark contrast to New Hampshire, by the way. Vermont, 8.75% income tax, 6.18% sales tax. And by the way, for all of these, I'm reading the top rate for income tax. That's not like a maximum, or that is the maximum. I'm not reading like a flat rate for every state. And a 32% gas tax, 32 cent gas tax. All right, moving on. Property tax in the state is the 8th highest in the U.S. Yes. What's this? What changes the state made to its tax structure in the wake of the new federal tax law mean that all filers will now have to take Vermont's standard deduction. If you have a big mortgage, for example, that might work against you. Oh. Well, that's not cool. Hawaii. All right. Hawaii has one of the highest state income taxes in the country. 11% on taxable income of $200,000 if you're single, and $400,000 if you are married. 4.35% average sales tax, and 48% or 48 cent. I keep saying that. 48 cent gas tax. Property values in Hawaii are high, but their property taxes are relatively low by comparison. For example, the median home value in Hawaii is $538,400, but the average property tax is $1,459, which isn't that bad by comparison. Gas taxes, of course, are 48 cents per gallon. The problem with Hawaii, besides its high income tax, is its sales tax. The sales tax doesn't seem that high. However, it works more like a VAT, a value-added tax, because it imposes its sales tax along, basically for every level of transaction. So as it says here, so that's part of the reason prices can seem eye-poppingly high to mainlanders, since they are imposing this tax along several levels of the production chain. Of course, when it gets to the final point of being passed to consumers, that's a lot of tax to recoup. Moving on. No one's surprised by this one either. California. 13.3% income tax, 8.55% sales tax, and 56 cent gallon per gallon gas tax. That's getting pretty nasty. California has the highest statewide sales tax at 7.25%, and then of course you count local sales tax on top of that. Californians have lower property taxes or lower property rates than residents of other high tax states, but in a state with some of the highest real estate prices in the U.S., bills are still pricey. In the Bay Area and other parts of the state, where an average home cost upwards of $1 million, the $10,000 cap on state and local tax deductions will effectively increase the cost of property taxes. So, in that case, the limit on property tax deductions is going to be felt. I suspect that's one of the few areas in the country where it will be, but that's my opinion. All right, moving on to number 9, New Jersey. Aha, we're going back to Yankee land. All right, New Jersey, gangster territory. We have, all right, just kidding, guys, just kidding. All right, New Jersey, 8.97% income tax, 6.6% sales tax, and 41-cent gas tax. New Jersey's property taxes are the highest in the U.S. Just so you know, that Garden State makes you pay through the nose. For protection, of course. And at 41 cents per gallon, they have the 9th highest gas tax in the country. And moving on to number 10, Connecticut. They have a 6.99% income tax, 6.35% sales tax, and a 44-cent tax on gasoline. Connecticut's property taxes are the 4th highest in the U.S., and they have the 7th highest gas taxes in the country. On the plus side, there are no local sales taxes, so you only pay the statewide rate of 6.35. All right, so that's it for the evil states. And I say, if you live in any of these evil states, move. Come on down to the southern states. It's nice and warm, because that's something I noticed with a lot of these evil states, is they're cold. Come on down to the southern states. We have this thing called summer that a lot of these other states don't have. We also have more friendly tax rules. So come on down. And since we have friendlier people as well, you might want to actually stick around as you're keeping more of your money. So there's that as well. All right, so that is all for this episode. I thank you for being part of this audience. And if you would like to support this program and keep it running in the future, there are several ways that you can do so. First of all, you can go to the right-hand side of rcretirement.com and click that link that says, click here to shop on Amazon. And by doing that little action, you will just simply go to the Amazon homepage, and what you've actually done is activated a little cookie on your computer that will, oh no, you're going to be tracked. Uh-oh. It's going to track what you order, and by doing so, when you place your order, it's going to send a small commission back to me as a thank you for sending you to Amazon. And I will be most thankful for you having gone to Amazon. And if that's not enough, if you would like to support the show in another way, and actually, just like I did last time, I meant to do this at the beginning, and just like I did last time, I forgot to mention the two people who have joined me on Patreon. So if you would like to support this show in another way, you can go to patreon.com, and I will mention you in my next episode. And the two people who have joined since the last episode are David and Clint. I would like to thank them both for having joined the Patreon campaign, fledgling though it may be, and for supporting them at the levels that they have. You're making this a little bit easier each month, and I appreciate it. And if there's anyone out there who would like to do the same as David and Clint, then please go on over to patreon.com/rcretirement, or just click the link that says click here to join the Patreon campaign. And then you can choose any of the pre-established tiers that suits your needs, or you can create your own tier of support. And then you are doing your part as well to support the show and keep it going every month. Another thing you can consider is I am now a fee-for-service retirement service officer. You can contract my own services for your needs, just like Clint and a few others have done in the past. You can approach me, tell me what your issues are, and have me fix them for you. You can go to the rcretirement.com main page and click the tab that says fee for services and get an idea of just how much it might cost. Of course, everything's negotiable these days. Give me a message by email, dj@rcretirement.com, and let's work something out. Let's see what I can do for you. All right. So I think we've had a wonderful episode today. If you have any questions, comments, or concerns, please shoot me a message. And of course, I'm about to point the wrong way, aren't I? Yes, I am. One thing to remember, if you're on YouTube, then come over here and click this little RC Retirement logo here, because my goal is to hit 1,000 subscribers by the end of this year. I think that would really be cool. And of course, I need everyone's little mouse clicking buttons to do that. So come on over and subscribe. Help me do that. And of course, if you know anyone that can benefit from the information that's being put out here, please spread the word about this podcast and this YouTube channel and the radio program that's put out every Sunday and the SoundCloud archives of the radio show and all the various resources that are available on rcretirement.com. This is a service that can benefit a lot of people. We just need to get the information in front of the right eyes. So I'll keep putting out the content, and I ask that you guys bring in the folks who can most benefit from it. So as always, I say a heartfelt thank you for all of you being part of this audience, and thank you for your time. I look forward to seeing you at the next episode. Thanks again.
If you liked what you heard on today's episode, then please go below and give it a thumbs up and be sure to subscribe to this channel. Also, please let other people know about this channel and the information it can provide for them. If you have questions or comments, then please have no qualms about posting them in the comments section below. Please remember the RC Retirement YouTube channel and the RC Retirement website are not recognized or endorsed by the Department of Defense, the Department of Veterans Affairs, or any other government agency. The information presented in these resources are for entertainment and informational purposes only. Also, the content of either of these resources should not be considered financial or legal advice. Please consult with your own legal counsel, accountant, or financial planner before making any decisions based on what you have learned here. As always, thank you for watching the RC Retirement YouTube channel.